of price crossing that 50 moving average when we're seeing the 50 crossing the 0 line. But the thing is, you'd have to go like this. If it were an uptrend and you wanted to see the pattern, you'd have to go, because the 50 itself is going to be going this way, the 50 period moving average. So it just can be easier to recognize these patterns when the moving average itself is made stable. Okay, and
with the highs and the lows in the CCI within the period.
That's the distance between the price and the 50 period moving average.
Oh, okay.
Yeah, and that's why I said if you're using Bollinger Bands instead, what do I have up here? Oh, charts.
Deviation, two-standard deviation.
Yeah, if you were using Bollinger Bands, when you have, let me unscrunch this chart. That's what I need, a remote chart unscruncher. If someone would like to invent that, I'd appreciate it. When you're seeing this bounce, if you were to put a Bollinger Band on the chart instead, what you'd see is price bouncing on the outside of the band. So that's, as an indication of the strength of trend.
Walking the band like John Bollinger used to say.
Right, yeah, or in Keltner channel. I used Bollinger for a bit, and I was trading a lot with Keltner channels for a while. I had a couple of systems. I had a mechanical counter trend system that used Keltner's, and we called that upside running pattern when it was hugging the outside of the line. Upside running pattern, downside running pattern. I think what we're gonna do is take a look at a few example charts I have. I'm afraid of getting into timing work in too much detail right now, because I think we are covering a lot of mechanical stuff here with the CCIs and the fib work, and I'd like to make sure everyone's straight on that and show some example charts, run up some charts together, and if we need to, we'll choose a time to put aside to go into the timing also. Trace Burton is going to be doing his presentation on his materials sometime a little bit after 3 o'clock. And he's asked me to basically shut up at around 3 so he can start getting set up. So I don't think it would be fair to try to do everything about timing work in 1 hour. How do you guys feel about it? Would you like to see some of the stuff about how to run timing now and think about it?
Yes.
Okay, you'd rather get into the timing now?
Yes.
Okay. Well, then I'll reverse that a little bit. We can get into some, really, I'm open to feedback. Like I said, this is your session. I also want to run up a few charts that we're going to print out and you're going to add to the workbook. So we can do that focusing on timing instead of the other stuff right now. But I feel like I've given you some of the mechanics of this and not how to use it all together. As I was telling Rodney outside, I always consider these weekend days when we're talking about the mechanics of the stuff and the elements of it as a precursor to the live trading days, because that's when you really get to see the stuff work together. If this doesn't seem cohesive at this point, because I know it doesn't to me, it's because I'm trying to show you the elements. So when we're talking about it during live charts, when they're actually moving, you at least will know what that red line is, that that's my symmetry. And you'll know that we're aiming for the green lines, the targets, and so on. I can refer to the CCI triggers as they're occurring without having to first explain what they are. So that's what today is for me, is it's a basic setup for, just like yesterday we did the software setup, giving you the elements of what I use to trade. And are we all back, or are there people running around outside? I don't know. You want to check this? I was just wondering if there are people out there that should be in here. So yeah, we can look at some timing instead. I mean, there's really, that's fine, and that way you'll have the other tools intact in place. Okay, let's go back to that PowerPoint. I think would be the easiest way to break into that. I'd like you guys also to look at, in your extra spare leisure time, look at this trade management page in the workbook, and if you have questions about what I'm talking about here, because this is stuff we're going to be using on Monday and Tuesday, if you have questions, jot them in there, and make sure to come back to me with the questions, whether it's when you see me, gallivanting in the streets later on, or tomorrow, or on Monday. I just would like to really make sure that we're addressing any questions that these materials are bringing up. Okay, Fibonacci timing. Fibonacci timing is one of the most, to me, I mean, from what I've heard, the feedback I've received, it's one of the most misunderstood and confusing things. Because in reality, it's really simple. When I first started doing the timing work, I thought it would be an overwhelming thing to even try to understand, to wrap my head around. And it turns out that it really, the sooner you can forget about the idea that it's complicated, the sooner you'll become proficient with it, because it's really not complicated. It is almost impossible to make a mistake in doing the Fibonacci timing work. It's actually, I don't want to say this the wrong way, it's actually easier than the price work. The price work takes precedence, though. You have to know how to do the price work, and you have to understand what to expect in the price work. But the timing work is actually easier. It just can seem kind of magical. When you have price and time come together, I'll show you a quick example here, because I have a few. Let's see. Here's a stock. This was a stock, actually, this is a couple of years old, or a year, whatever. Yeah, almost a couple of years old. This was actually something I had run up for someone. And I have this on my website now as an example. This is an example of price and time coming together. And by that I mean that you can see this VPHM was attempting to rally again up there. See if one of these is working for me. Oh, the dollar sign one, I think that's a little too dim. Can you guys see that?
Yeah.
Okay, great. Acquaintance, part-time client, whatever, was still long here, and I was like, Michael, I think there might be a reason. I didn't know that would happen. I really had no idea that would happen, but I said, there's a reason why you have to be kind of concerned about your long at this point. He said, no, it's no problem, whatever. This was very commonplace for any security to fail if it's made a significant high is the 786 back up.
Yep.
Okay? That is, when you hear me talk about a failure swing, I'm usually talking about made a significant high, price attempted to rally. By the way, notice here, and we'll see this on intraday, on a monthly chart, on a 10-second chart, the 786s will very often coincide with the 50 CCI plus 100 line. That's your danger zone. Remember I talked about danger zones before. Yeah, you had a long trigger here, but something that we follow all the time is once you put in a significant high, meaning, we can even tell the CCI was way extended above the plus 100 line, came back down and broke below the plus 100 line. Okay, that's why that's a good place to exit a trade, because you can't be sure if that's going to pull back and trigger long for you again. Very, very often, when you get up to a significant high and you have an extended CCI like this, what happens is the next long side setup fails, and very often you set up a Gartley pattern. And I'm not going to go into Gartleys too much because I think Chris has some very thorough information about Gartleys. I'll show you how I do Gartleys during the live trading periods. But a Gartley basically is a zigzag. And it represents indecision in the market, jostling into position for, do we want to reverse? Do we want to resume the long side? So often when we have a significant high like this and the 50 CCI breaks back down below the plus 100 line, I will skip the next long side trigger. If that means that this goes all the way up here and ends up on the 30th floor of this hotel and I missed out on it, so be it. It saved my butt a lot of times to skip the next trigger on our immediate triggering time frame. If we had, this is a daily, if we had a weekly chart that also was triggering, that would be a different story. But my point is, my friend, client Michael was long here. And I was like, let me just take a look at that chart. We had our 786. We also had symmetry resistance. The symmetry resistance was the swing into the high projected from the low after. That's pretty strong overlap, telling you there's a couple of reasons why price might fail there. These are all these cute timing lines. Okay, you know how long that took to do? It took about, I don't know, a minute and a half. Because I've been doing it for a while. It can take you a minute and a half too, because all you're doing is looking for significant pivots. What's significant about those pivots? They stick you right in the face. There's a low. There's a low. There's a high. There's another low. If the timing is going to be valid, you can connect as many of these as you want, and you'll still have a confluence where they line up. You can't make a mistake. This is almost a mystical kind of thing how this works. But if you're going to have a good set of timing overlaps, the more pivots you use, the more it's just going to reinforce where the timing actually is lining up. Timing, what does timing mean? Timing means that you're going to see another pivot put in. We can't tell always in advance how dramatic it's going to be. And by the way, where this did decline to was the 1618 target of the swing into the high, our U-turn. But when you have time and price come together, you see, price hit there, then. It was there and it was then. And that tells you that you better pay attention at that point. It was talking about a heck of a lot of resistance that I wouldn't want to be involved in.
What was the duration of that chart? I can't.
This is a daily.
Daily.
Yeah, this is a daily. And we use timing a lot intraday, particularly on our stock index futures. Let's see what I have in here. Do I have any timing on this one? Yes. This is a Russell chart, 15-minute. And this is the kind of activity I really like to see in the Russell or in the intraday stock index stuff. This is going from extension to extension. And it's really cute because basically what happened here, swing into the high, see we were projecting our U-turn. So this extension, low to high, times 1618, it bounced. Then we had high to low, times 1618 was the target. And it was 1618 in time price square also. And be aware of that. Let's go into the difference between how we use timing when we see squares. Time price squares are the most powerful type of timing. And then there's the other, more confusing type of timing. But I say that partially as a joke because really, once you get into doing it, it's not confusing. I promise. Here's the dry stuff. The same analysis we've used on the price axis involving symmetry, retracements, and extensions can also be applied to the time axis on our charts. A confluence of Fibonacci time factors will help us see basically where you're likely to see a reversal. This is kind of important too. Time analysis is best done, this is particularly for intraday. Time analysis is best done on a longer time frame than the chart you're using for entries. A few reasons for this. One of the reasons is, as I say here, you can look for signs of the reversal on the shorter time frame. In other words, let's say, what do I do with that Russell chart? Okay, let's say that we were long here on the Russell. This is a 15-minute chart, okay? And we knew we had a time and price factor coming up. In other words, we knew that if we were extending in price-wise at that point in time, literally at that point in time, that we would need to watch for signs of a reversal. So what would you see? You would step this down to a 3-minute chart, and you'd have your symmetry support, in other words, measuring the rhythm of the trend on a 3-minute chart. And if you saw that when this came together, and it bounced off your price and time target strong enough that it started to break your 3-minute support, you know the timing is holding. And you know that not only, by then you should have been out of your longs, but you know it's time to look for short side. So you try to do the timing on a chart that's a level above your execution level. The other reason you do that is because the higher the time frame you have fib timing show up on, the stronger it is. If you have to go down to a 3-minute chart to find those highs and lows to connect the dots and get the timing, well, 3-minute timing is going to get you a shift in pattern on a 3-minute chart. If that's significant enough, then you're a micro scalper. You know, that means that you're really looking for very short-term moves. 15-minute is good though for intraday moves. Yes, Leonard.
So now what you're telling me is you're watching those too, but you're trading on the volume.
I'm trading on the...
Usually on the volume. In this case, you just
my CCI triggers are on the volume.
The triggers are only on the volume.
The triggers are on the volume. I don't do the fib work on the volume charts. Our layout, our intraday layout.
Okay.
Our intraday layout, for instance, for the Russell, our intraday layout is a 15-minute chart and a 3-minute chart for the fib work. Okay? And then we have a couple of volume charts. We have 2 volume charts.
Yeah, so you got about 4 charts on here.
Yeah. But we don't have fib work on all 4 charts.
Right.
And
Right.
It's just that and for the contracts or securities where we don't have the volume factors or we don't need them, then we just do everything on one chart.
Right.
You know, like the bonds, for example. I can show you, actually I can open that at some point. We have a bond layout where everything is on one chart, 15, 30, and 60-minute chart. There's also a way to trade. We do have volume factors for bonds. That's a full-time job if you want to trade the bonds off the volume chart. So we don't really run that in the chat room. It's really easy to scalp bonds, though, if you want to make some money, you know, quick in and out during the day. So the volume chart is good for that. The gold, we only have one chart. We look at the daily to get key levels off that, but then the daily gets minimized. We have one chart.
Do you see some chart better than others?
Do I see some chart?
Yeah, like maybe the S&P, or maybe silver contracts chart better than the S&Ps, or you know, certain things they seem to chart better. I mean, not with this.
Do they seem to chart better?
Yes.
It's kind of cyclic, is the best I can say. I mean, like for instance, a few years ago, when I first got into looking at the bonds, as an example, first got into doing the bonds, as far as I was concerned, could do no wrong as far as the fib work. They were following the fib work, and they were following the CCI triggers so well that I was thinking about there must be some way for me to totally automate this. I mean, it was really working well. Then there was some kind of shift, and it wasn't as reliable. It wasn't as reliable, and basically, you know, you got to keep your journal, and when you see your trade stats decrease, you see breaks of levels that weren't breaking before, triggers not working out at an increased level of, you know, increasingly not working out. You have to start just, you know, backing away.
Because the market changed?
Yeah.
From a bull to a bear, or?
No, but not necessarily bull to bear. It might have been some sort of volatility shift. You know, could have been anything like that. I love bull and I love bear. I like bear a little better, for intraday anyway. But it's cyclic that way. I mean, there's some stocks that really, like Google, for example, is great with fib. It hasn't failed with fib. It comes down to supported triggers, it goes to targets. But look what Google's been doing. You know, I mean, that's only been one way, essentially. There are some that just are that way. There's some that'll break right through. There's some, but it's difficult to say in advance. Yeah. Okay, so let's see if I can clarify this a little bit. Yeah, you can watch, in other words, if you do let's say you're doing intraday, you do the timing on the 15-minute chart, watch for reversal signs on the 3-minute. This is the only time I look for divergences, though, in CCI. In other words, I look for situations where an indicator is making lower highs and price is making higher highs. You guys know what I'm talking about, divergences, right? Okay, because just about any indicator is going to give you divergences a lot. And people will I think they miss too many good trades if they say, well, I can't take this long because there's a divergence. I have to get out of this long, I should go short because there's a divergence. When you have a divergence, let's say with the 50 CCI, you're making lower highs and price is making higher highs, and you're getting into one of these things, okay? Then you listen to it, because the divergence is telling you that the momentum is putting the brakes on. And it's most likely going to respect that timing. And I mean, if I dig into my hard drive here, I have about 1,000 examples of those kind of price and time things coming together. Let's actually see what other example. It's just a sim demonstration. I think I have some
When
other.
do you look for divergences, Mark?
I'm sorry?
When do you look for
When there's timing, like here.
When there's timing.
Yeah, like here. Here's 15-minute timing. Is another Russell chart. Okay? This is an example of near overlapping targets. Near overlapping targets. In other words, here we have 1272, a U-turn. That was low to high. 1272, see? And 1618 also low to high. Okay? Also, quick little timeline here. This is another square, by the way, and I do have to. Does anyone here know what a price time square is or isn't? Anyone want to tell me what a price time square is? I had to say that several ways because the first time I said it was totally backwards. You know what a price and time square is?
It's when time and price come together in the same bar, basically.
From the same swing.
From the same swing.
Yeah, this is a time price square, and what that means is you see how we have a target here. This was low to high, 1618. Target was hit precisely. Okay? Using the same swing, low to high, with the time tool, the 2-point time tool, it hit that 1618 target at the 1.272 timing factor. In other words, this low to this high, count the number of bars, multiply by 1.272, it hit the extension of price at the same time as the extension of time. Those have a 90% probability of being a significant reversal. No joke.
Being a significant what?
Reversal.
Reversal.
Yeah, they will pull back, this is a small square actually, they will pull back close to 100% of the time, at least 0.382. In other words, if you ran a 382 retracement from here to here, took a retracement series and went high to low, stands almost 100% probability, above 90% at least, of coming up to the 382 retracement. That's why you can say, well, do I want to ride through this? You know, how much would I be giving back if that kind of situation were to arise? My point, though, is the squaring is where the timing is most powerful. Squaring simply means that you are at a price and time relationship determined by the same swing. Okay, does everyone see that? Okay, now in a case like this, I don't have a shorter term chart from the same time period here. I did actually have a lot of examples of these things put together, but I had a couple of issues here with the computer also. If you were to look at your shorter term chart, like your 3-minute chart, and you saw a divergence then, you saw divergence. In other words, CCI was making higher lows as it was making lower lows on price. That would be warning you. It's time. You'd want to at least get ready to get out, and you'd get out then when you broke that minus 100 line. Okay, so that's when I look at divergences, when you have a timing relationship coming up. Two reasons to use timing, and this is kind of interesting. The more dramatic timing is when it gives you a real dramatic reversal. In other words, you're going up, 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 and you have a whole bunch of targets up here, and you have timing, and then it hits the price and time stuff and plummets downward. That's really dramatic. And it's nice to use, and it can also kind of let you know in advance that it's going to be time to look for short side setups if you're in a rally. The more routinely useful timing is when you can time for the termination of corrective pullbacks, corrective balances or pullbacks. In other words, let me see if I have an example of that, because I really haven't been good with the examples here. Let's see. Right, this is an example of timing to show you the termination of a trend. So this was clearly an uptrend. Okay, clearly an uptrend. And if I'm not mistaken, yeah, this was squaring too. See, 1272 in price, that was from high to low. Same swing. This is using the 2-point timing tool, the one that says timelines. All you do is, anytime that you see one of these U-turns forming, and again, you don't have to wait for this whole thing to be formed. All you needed was this high and this low. Have a potential U-turn. Use your retracement tool, high to low. You'll have these extensions up here, meaning that if the swing is going to complete, this is where people would go, wait, yeah, it's supposed to rally, but that's enough for now. If you use the timelines tool on the same high and low, and you meet that extension just when you have the timing extension, this is what you're going to see. Again, when it's from the same swing, you're going to see this kind of effect 90% of the time. But you don't see that often, the squaring. When you do, you have to wake up and notice. That's one thing about the fib work too, is that's happening on your charts whether you plot it or not. So it makes sense to kind of be aware of it happening.
And you also have a divergence in the CCI.
Yeah, in this case you can actually see the divergence here. This is on a daily. This is another stock. So yeah, this is kind of telling you, look what happened. Had all this information on the chart in advance. All you needed was this high and this low. Which means, by the way, anytime you have a high and low, you project the extensions here too. High to low, you would have taken your retracement tool and gone high to low to see if you have targets. You know what happened here? That failed at the 786, of course. Yes, Peter?
Mike mentioned, I believe, that if you can't use this timing on range bar charts,
Right.
tick charts, or volume charts.
Yes, definitely. And I've had someone fight with me about that recently. Someone you know. But, was that just a stretch? Okay, I thought you were raising your hand for something. Yeah, you have to use timing tools. Thank you for reminding me, Peter. Timing tools are only to be used on time-based charts. As a matter of fact, in Fibonacci Trader, if you took a volume chart, I don't know about a range chart, but if you took a volume chart and you tried to run a timeline, it would project the time as 0. Because we're actually not counting bars. We're actually looking at time. And because a volume chart or a range chart or whatever, or a tick chart, doesn't have close, doesn't close and start printing at a specific period of time, it depends on how fast the market moves, you can't know at what point in time a certain bar is going to print. So you only do timing on a time-based chart. And yeah, you're right, here was the divergence in this case. So when you had this relationship setting up, you could see already that your momentum indicator was saying, oh, not quite, I don't think so. It's not really there for me. So that's the kind of timing that can show you a dramatic reversal. The other kind of timing that we use a lot intraday is, I'm not sure if I have an example of this here, but this is the kind of thing we'll have come up in the live trading, is when you have a, okay, this is another square. Apparently I must have put together a folder that had a lot of time price square examples, and you see how dramatic that is. Wouldn't you like to know about that in advance? So that you can, close out your long trade, your long side there, because that was what? That was like a 10-point drop to where it was 13 point. That's $1,300 per contract in a few minutes. The other kind of timing, though, is when you're in a rally and you start to pull back, you would time for a pivot low, so that you can tell if there's a likelihood that your trend will continue. That's timing for the end of a correction. And let's see if we can come up with an example of that, because it'll give us a chance to look at the tools. Let's get the program itself up. All right, let's look at this bond daily again, since that served us so well. If this high is going to hold on our bond daily, wouldn't you say then that what we had was a corrective bounce, right? Within the downtrend? If this is going to reverse again to downside, we would have the termination of a corrective bounce. So if we had timing highs, let's say right there, that's not a dramatic trend reversal timing, that's timing to tell us that the corrective bounce is over. Let's see how we do that. We can start off with our 2-point timing tool. Okay, the one that says timelines. And all you do is connect the dots, literally. You take prior pivots. Let's say you could take low to low. Okay, this one, the main timing, this is what you'll discover when you start playing with these tools. If you use prior swings that are too close together, by the time you get into the present, all of your timing relationships will have expired. It's kind of like doing a retracement. Take a look at the chart and you'll see what I mean. You see how all these things have already, all those dates have passed? Right. Okay? So that's because it would be like, here, I'll show you. The idea is you connect outstanding prior swing highs and lows, okay? So, here's one right here, low to high. But just because I have experience with this tool, it lets me know that's going to be meaningless because all those timing projections have passed already. Lesson, the moral of the story is, the more back in time you're going to go to find these swings, the larger the swings have to be so that some of them project into the current time. Okay? So, let's see what we can find. Well, we can go low to low here. With the 2-point tool, you connect basically every pivot that you see. Lows to lows, highs to highs, highs to lows to highs. It doesn't matter, direction doesn't matter. You just connect every pivot that you can see, because all you're doing is attempting to find a place, or a time I should say, where a lot of these pivots have occurred before and project them into the future. The bar counts. You're taking the bar counts from the past, pulling them into the future. Okay? Everyone clear on that? Okay. This one also, just about everything's expired except our 2618 is all the way out there. This one has an August 2nd coming up, so we'll leave that. Now, the more powerful timing is from the more powerful Fibonacci relationships. In other words, a 0.618 in time is going to be more powerful than a 0.382 or a 0.236. So what we want to find is a situation where we have 3 or more within 1 bar of each other. Don't have to force it. There's no need to even try to force it. What we're going to do is just connect these pivots, and that's what you have to practice on to do this. It's just connecting the prior highs and lows. Okay, we have one 724 here. Just scrunch this chart a little bit. We can take, we did that low to low. Let's take this low to low. Okay. And to use the, and what I do really every time I project one of these, I get rid of the dates that have passed already just to keep the chart neater. If you switch back to the arrow, you can grab the line and move it so they're not all on top of each other. And so, let's see, what else we have? Low to low, let's see. I know it's really fascinating watching me do this, but hopefully you're playing with it yourself. Okay, I have a 723, 726, 724. Okay, now what you do with the 3-point tool, we're rallying now, right? So, 3-point tool, you take prior rallies. Low to high. Oops, I think I missed on that one. Take low to high and project from the new low. Okay? Here's another one. Low to high, project from the new low. Okay, let's move that and see what kind of lineups we're getting.
724.
Yep. 723. 711 is passed. 718 is 2. 724, 725, 723. We have a lineup. That's timing for a high, which would be timing for the termination of the corrective rally. Yes, Peter?
Why did you not take the last two highs?
Which ones?
Move it to the left a little. More.
More.
To the point, move the pointer. Oh, that, I'm looking at the wrong one. No, one more to the right.
Here, I'll use this
From
one.
there,
Yeah,
down to the next high.
down to the next high?
Yeah, and project from there.
Because, well, wait a minute, here, from here to here?
Yes. And then project it out from there.
Project, because that's,
On the 2-point tool.
oh, I could do that with a 2-point tool, certainly. I didn't realize I hadn't. I'm glad you pointed that out. Just, might be too small, but we'll see. No, it's good.
Bingo 100.
718, so that was actually Thursday.
Oh, no, I'm looking at the current high. It's going on right now. Right
This?
there. Yes. You're at 1 to 1. Aren't you?
But wasn't that high made on the 20th, so it's 2 days off.
Okay.
Yeah. It's a timing factor, and I should run that swing in case other things lined up there, but we also have some timing coming up for the 7th, 8th, and 9th, so we actually have a couple of cycles coming up there. The reason why this is timing for a high is because we've included the use of the 3-point tool measuring prior rallies and projecting from the beginning of the current rally. See, if you couldn't get any kind of a projection from the 3-point tool that landed with these other projections, all you'd have is timing for something, for some kind of pivot.
Gotcha.
You need to have, yes, Leonard,
Using 3-point tool.
the expansion tool, the time expansion tool.
Oh.
Okay, it uses 3 points.
3-point tool.
Yeah, it's also called the 3-point tool. It's called the 3-point tool because you take prior swings.
I see 382.
Oh,
No.
3-point.
3-point tool.
Point tool.
3-point tool.
It's not registering. I'll show you. I'm glad you're bringing it up. I want to answer these questions. It's the 3-point tool because you use 3 points.
Oh, okay.
Okay. You take, in other words,
It's too simple.
on the program when you hover over it, it's called time expansion. Okay. Because you're taking the prior swing, measuring it, and projecting from the beginning of the current swing. So let's see. Before this gets all too confusing, let's see what this chart is telling us. 718. I'm sorry, Peter. I think I'm going to take that one out if you don't mind. Okay. 23rd is, well, it's okay. Should I count on my fingers? Today's the 21st. 23rd is Monday. And we also have the 24th, Tuesday, and the 25th, And what's this, the 27th? We've got a lot of timing coming up this week, but we have a cluster. Remember, they have to be within plus or minus 1 bar. So this is focusing more on the 24th. Let's look at the relative strengths. Okay, 25th is 100% of a prior rally. That's a strong timing factor. A 0.382 of just a prior pivot, prior swing, not that strong, but it's nice to add as a confirming factor. What do we have up here? 50% is a decent timing factor from a prior high to high. Yeah, that's okay. So these are adding up pretty well. The idea is you look at these nice pretty colors and you say which one of these zones has more of the strong stuff. The strong stuff would be the 100% symmetry numbers, the 1272s, the 1618s, 618s, and 786s. Use 382s, I think I have this all written down in there too. Use 382s and 236s more as confirming factors. In other words, if you only have one of these lineups where you have two good ones, a 618 and a 100%, and then you have a 382 or a 236 landing on top of it also, that'll confirm it and give you those three lineups that you need.
So, yeah.
1 second. Yeah, Jeff.
So I was going to say, with we've got for the 24th, we have a 382.
Yeah.
We've got a 50%, 720. And then what else?
Well, let's see. We have a 100% of a prior rally, and where's our other? Did I erase something here? Because I would have thought there'd be 100. Let me just check if I got erased crazy.
23rd.
I want to take this one again. Just want to take this one again because I thought there was something else there.
There was something on the 23rd.
Yeah, that's the 18th. Also,
There it is up on top.
the 50%. Yeah.
Yeah, so we have a 318, a 50%, and 100%. Would we consider that strong timing?
It's good timing.
It's good timing.
Yeah, I mean, if you want to say, if you want to look for a really strong timing overlap, you'd have more of the 1272s and the 618s, the powerful stuff. But what overrides that is the fact that if we are actually making contact with this resistance, when those are the timing factors in play, then you got to pay attention to it.
The price resistance.
Yeah, the price resistance, price and time. It's not squaring.
Right.
Okay, let me show you one other little thing though that you can do, because also incidentally, again, I don't want to get into too much talk about Gartley's right now, but what do you think this is? So in other words, we have actual extra resistance here, and because of that, one other thing we can do is divide this rally into two rallies. Okay, so what we want to do is take the expansion tool again, the 3-point tool, low to high from that low, and now we have 100% on the 25th as well. So we have 200% levels on the 200% timing factors on the 25th. We have some stuff on the 23rd, the 24th. We have the beginning of the week as major timing high in the bonds. I forgot something on here too. Here's another little U-turn that occurred. So, see this one? We already plotted this one. This high to low gave us this extension. What about this one? High to low. Oops. Timing and price with price extension overlaps. Look at that. Couple of successive swings, both saying, time to end this swing right now, time to end this rally right now. And it's saying also with our timing data that the beginning of the week is when the cycles would repeat. The time cycles that have already expressed themselves over the last few months are coming into play once again. Monday, Tuesday, Wednesday, focus on Tuesday, let's say. That's a lot of resistance. And some of that resistance is the green stuff, which means this is where you should be taking profits, not entering a trade, because this is where the rally is likely to terminate. So that is an example of using timing to determine when you have extra resistance to terminate a corrective move. This is not the top of a big rally and we have timing saying it's going to be all dramatic and fall down, but it is telling us that each time we've had a possible corrective rally, or we've had a corrective rally before in the bonds, If the pattern is going to repeat at all, if the cycle is going to kick in, well, you got a lot of data here telling you it's going to be beginning of the week against this stuff. Yes, Lou?
So are you looking at a 2-day or a 3-day or? Is that what you're doing?
Well, you basically look at the one in the middle. You look at the one in the middle. In other words, if we have a couple on Monday, we have a couple on Wednesday, we have a couple on Tuesday. So we say the focus of the timing is Tuesday.
And your confirmation is a CCI.
Confirmation will be what happens. Confirmation will be seeing it fall off from that resistance.
Right.
Right. The confirmation that we would look for in the chat room, for instance, because we trade this stuff intraday. So what's happening on the intraday chart? Are we starting to break down? Let's take a look. Would we be starting to break down? There we would look at the CCI. The CCI here on the daily, let's open that up again. On the daily, the confirmation on the CCI, if we were waiting for a daily trigger, you're in a great position if the 50 gets back below 0 and the 14 joins it, you're going to have a 50-30. So you're going to have all kinds of CCI triggers. You're going to have 50-34 short, 50-14 short. You're going to have all kinds of stuff happening there. But even if you're just trading this on a daily basis, if you have the time to take a peek at an intraday chart, and there's that extension that we're up against right now, what you want to see is, are you going to start to lose the symmetry support on the intraday? In other words, if we take these prior, remember what I was saying before about if you have timing for a high on a 15-minute chart, look for a break of support on the 3. So in this case on the bonds, we're looking at timing for a high on the daily. We can look for break of support on the 15. And so I'm just taking, basically I have to go back and take each one of these. By take, trace the prior high to low swings and project from the new high. And if you start to see the symmetry support break, and you get short triggers here. Now, what kind of triggers have we had on bonds recently? Let me just step back over here. Let's just go back to, by the way, this is off by a day, the timestamp here. This is data for Friday the 20th, but there's a thing in how I have, that's why I had Carlos come up here and say, help this morning. There's a thing in how I have my times set, so it actually is off by a date down here, but this was actually Friday, and it looks like we had some long triggers. And no indication that we have to bail. Friday, here you have a 50-34Z on our highest time frame, 50-14 on the middle time frame, 50-34Z, and we of course were sitting here. Because we had long triggers early-ish on Friday, and absolutely nothing telling us to get out of the trade. We could have held that right to the extension, because we would have had all this support that's up here now would have been down here. From all these little prior swings, we would have had support, and we had long triggers. Now we're beginning to break down a little bit. What I would want to see, and Jeff can just about recite this with me because we both watch the bonds so much, is I'd want to see this 50 CCI cross down and give us a short side trigger. Give us a 50-34 short. You already have some of that resistance, major resistance cluster is visible here. That's that target. That target, was the last one I put in on the daily chart. You'd obviously be breaking through the support. 50-34 short here. You'd already have short triggers on the shorter time frames. The safest thing to do here, and believe me, we're going to check this on Monday and Tuesday and be there when it happens, would be you get your long-term short trigger. We have resistance set up then because we begin to form a pattern of lower lows and lower highs. When you get a little bit of a bounce, a little corrective bounce, these shorter-term CCIs will lift up a little bit, and then you'll get additional short-side triggers, and that's when we go pounce. Because the trend, longer-term trend, this data is 15-minute, 30, and 60, okay? When our longer-term intraday trend confirms to short side, and then we get additional short side triggers on our shorter time frames, we jump in. And like we were saying, we've only lost one of these bond setups in the last month, which I don't expect that to maintain, that kind of rate. We only have about 3 or 4 a week.
Yeah.
So,
Sorry.
You're popular. That's such a happy song. Happy and bouncy. So any questions about this at this point?
I do have a question on timing. It'd be easier on the daily chart.
Okay. And by the way, that was in response, Leonard, to your question. What I was saying is that's what we would look for to confirm the timing on the next higher time frame. We did the timing on the daily, so we're going to look to see how that affects us intraday. Even if we're trading the daily chart, intraday short triggers will warn us that it's going to set up short on the daily too. And let's switch back to the daily. Okay.
Just when you're timing for a high in that last the 3.2.
This guy?
Yeah. The very last one we did. Would you also use the 2-point tool for the same swing?
Yeah, you can. 2.2. You know where that would be most valuable? This high to low, because what if that were squaring?
Okay.
You know, all right. And you know, in the chat room, I hate to keep referring to the chat room, but it helps to remind me of examples that I've given recently. Sometimes, because this is a Gartley, okay?
Right.
This is. Remember how I say sometimes I found timing with and without the Gartley?
Yes.
Because if you really needed this most recent rally from the beginning, because this is not an outstanding low,
Right.
you know. So if you needed this low to high projected from this low in order to have three of them line up, the timing's kind of iffy.
Yeah, gotcha.
Okay.
Right.
But if you can find timing whether or not, and including this only reinforces it,
Right.
then it's telling you, you know what, this is something you really have to pay attention to. Now, flip side, let's say this all breaks through. Let's say tomorrow this starts to rally, you know, and breaks through our res. Tuesday comes around, our focus timing, and it breaks through. That means that the charts are saying that bonds are going to be up there on the 30th floor. Because when you have a break of the cycle, okay, when you have a break of the cycle, it means that there's going to be a complete change in trend. And the safest thing to do then, because obviously, you know, we'd have a hard time taking a long right now while all this stuff is in place. Wait for some of it to, you know, wait for it to start to eat away. Wait for it to break. Next pullback, you'll get additional long side triggers.
Because interestingly, we just triggered long.
Yes, which is why you also, you know, every trigger system will work this way. Sometimes the fib has to overrule it, and we see that a lot with the Gartleys too. That you get a trigger, and then all of a sudden it goes against you. Okay, and I know it's kind of silly when I say, does anyone have any questions? If I just threw this information at you, you don't necessarily have enough time to digest it, but come back to me with questions too. This example, though, is, you know, what I was saying, some of the earlier examples I was showing was, you know, it was rallying, we had price and time, and got to see a chance for it to fall off suddenly from there. This is the reverse method of using timing, which I actually prefer. I think it's more useful in trading to time for the end of a correction. And this will hold more routinely. Because if there's a rally going on and the rally doesn't want it, unless it's a square. If it's a square, it's going to hold almost all the time. But if you have all these timing factors come together, let's say we were timing for the low here, and you had a whole bunch of timing factors come together. You didn't have squaring, you know, from the same swing, price and time. That could still break through. And it would tell you, yeah, there's more to go down. There's more it's going to drop. Guess what? It already is dropping, and the timing scared you out of the short, possibly. This kind of timing is more useful to me, because it's just telling you that most likely the trend is going to continue. And we use this on intraday all the time. When we have, you know, we've had a rally and we start to see it fall off and we have support, we have fib support, we start to time to see where's the timing going to kick in. Where's the timing going to reinforce our Fibonacci price support? Because that's where you're going to expect a rally. Time after time after time, that's exactly how it holds. And we know that even if it's moving up right now, we have to be ready to look for it to move down and get out of our longs. Okay? So, how's that sound? I'm sure we'll have opportunities to see this stuff in action on Monday. And I want to see you all up close and personal with notepads when we cover the real stuff. See, I told you I can be bossy. So why don't we look at some chart examples and see what we can find? Unless there's something specific you guys would like to talk about. I will just open up some other charts. Let me do that. How about we look at gold? Okay, let's see what we have here on the gold chart. Here's a gold daily. This is gold futures August. And it looks like we had some decent support kick in here. The gold, we actually did also, we had a lot of resistance that broke through. We didn't have timing resistance though. Now, what would I do here to project? Anyone want to venture an opinion? How would I find targets if this is going to continue to be upside? What would I want to do? In other words, I want to see where this might end, the rally.
To do retracements from the high to the low.
Come on down.
Like this, right?
Yeah.
Because that's a possible U-turn, right? So what do we have here now? We broke through some minor retracements.
That one?
Yeah, we broke through the 618, so that means that that people are not that interested in it going down right now. If it broke through the 618, 786 is still in the way. If we break the 786, it will generally get to the 1272. So if it doesn't want to make a new high right now, you'll see the struggle here. Okay. Note that when it reversed, in other words, when it hit the low, we had a cluster of support, including 786 of a prior low to high. It didn't want to continue downward. 786 got in the way, 50% of a lower low to the same high. We had a whole bunch of support reasons to look for this to reverse to the upside. Now we also have...
Mark?
Yes?
Why wouldn't it stop at 1.0 instead of going on to the 1.27?
It does something. You know that is a double top. It's
Right.
double top, but most of the time you don't get double tops, so we don't project them. In other words, double top is a reversal indication, right? So what we consider that when we're looking at the fib stuff is we say, okay, you know what? That is a break of a 786 that did not reach the 1272. So that in itself to us is a reversal indication. If it breaks the 786 and does not make target, we start looking in the other direction. If we project the 100% on the chart, most of the time that will not hold. In my experience, most of the time it won't. It will only hold when you're getting a double top. It'll only be significant. So I try to keep lines off the chart that scare us. Yeah, because when I used to have more levels up, and I would do it myself, I'd say, you know what, I have a level coming up, I don't know if I want to be in this trade. Once I started showing the charts to other people, I found I really have to keep the charts as clean as possible, because otherwise they'll tell me, oh, I had a reason to get out of the trade, why did you have that line there if it's not important? Generally, when the 786 breaks, you will make the 1272. Now, there's no guarantee you'll make the 1618, it's just that's the next stop. Okay, that's where it will most likely go afterwards. There are a whole bunch of other levels that you could put up here. You could put up so many levels that just about every tick has a level. We try to focus on the ones where we've seen that they hold.
Just wondering about the 1.0.
Sorry?
I was just wondering about
Yeah.
the 1.0.
Oh, I know, but you reminded me because I get people asking questions about how come you don't use the 1.764, and so on. It's another thing. One sec. I just want to point out that I do use a 1.0, but I use this one. Look at this. You see this swing low? We exceeded it. We took it out. So low to high, projected from the low after. Okay, that's our symmetry resistance. If this is forming a downtrend, this is significant. Now, what this tells us, this symmetry, here's a way of interpreting what this is saying. This symmetry resistance represents a downtrend forming or downtrend holding. The 786 comes before that symmetry resistance. Generally, when the 786 breaks, we make the 1272 extension. So that means breaking the 786 implies the likelihood that the symmetry will break, invalidating, listen to this like a sentence, invalidating the concept of a downtrend. Therefore, the struggle will be at the 786. Okay?
Dollar value on 127? I can't see that.
Oh, the dollar value of 720.50. Okay, this is gold. 720.50. That's one way you can interpret this stuff, seeing where the levels come in relationship to each other. Because basically what we're saying is, if this still wants to form a downtrend, the 786 is where it's going to hold.
Is that a recent chart or is
This is current.
I'm showing 786 is being broken?
Which contract are you looking at?
Q7?
Okay, and you're looking at the ZG?
Yeah.
You have August though, right?
Yeah. Yeah, it's August, it's Q.
Q is August.
Yeah. Maybe we're not using the same swing for high to low. I went from this one.
Oh, I'm sorry, I went from the previous time.
This high?
Yeah.
Okay, I wouldn't use that high because generally when you have two highs, well, yeah, I mean, if you use this high, it was all broken, and you did get a double top, actually. You didn't make it to extension. In the current swing, because this one cleared all the retracements, I'd go to the next one. When you have two, that's in the rules actually that I wrote down about retracements. If you have two highs or two lows that are near each other, use the one on the right. Okay, it's the one that you're currently using. Yes, Chris?
Can I just make a comment? on
Sure.
that? Generally, kind of the way that I look at swings and determining, where I want to put my Fibonacci relationships and swings is, I kind of look at it in terms of the nearest price. So it's the most recently reflective of the psychological swings of the market. It's kind of the way I
Right.
look at it.
Yeah. Well, from a FIB perspective, one of the reasons we take the most recent or the one to the right is because if we were to take this high to low, all the retracements have been broken there before, so it's basically like, you're asking what's going to happen now. Well, you'd have to discount those, as you said, it broke. And Jeff, I think you had something you wanted to say?
I just wanted to get back to something you said before, and I meant to ask you about it. Did you say that if, talking about levels, if the 786 holds, let's say going on the upside,
Right.
that you're less likely to take the next trigger, long trigger up?
What you want to look for then is the next step here too, is we have to do our support. If the 786 holds and we pull back and break support, then we know we're not taking that trigger. There won't be a trigger.
Okay. But I mean, if the first pullback after, the first long trigger after a rebuff by the 786.
I will take that if there's enough room to make a profit back up to the 786. In other words, if it's going to retest the 786 and hold, I want to still have enough room where that was a valid trade.
Okay.
If it's going to skitter along, let's say above the top of the plus 100 line, and it's going to keep triggering long up there, and it's right up against that 786, no, I'm not going to take that because the risk reward isn't there. But one thing you can do with this stuff also, as I was mentioning, is you can look to see what the break of the 786 implies. And if the break of the 786 implies that other support or resistance has to break, then generally you'll see the struggle at the 786. So we have our support now. You can see where these guys came from. It was just the pullbacks. Actually, there's a little one right here. And this will be interesting to watch over the next couple of days as well. Another interesting thing here, though, is that we have a break of the plus 100 line on the 50 CCI. Implies that we have a lot of upside momentum to possibly break that 786. Another thing, there's a smaller U-turn here. See this high to low? And that's the swing into the low. High to low. And you know what I think is going to happen there is, it's going to reinforce the 786 resistance with an extension. Now, a lot of the times this turns into a picture that looks like, well, what do I do? There's no way I can trade. There's lines all over the place. They're all in my way. That's why you use the momentum triggers, because the momentum stuff is going to tell you which side is going to hold and which side is going to break. That doesn't mean you do something stupid and take an entry right when you're up against a whole knot of the resistance. This isn't in response to your question, this is just in general, like on the bonds. Now would not be the time to take a bond long today, because we had that resistance this thick with timing. But if it pulls back a little bit and you get a long trigger, if there's enough room for it to make up, to get up to that resistance, and if you have to get out, at least you put a few dollars in your pocket, then it's worth doing, because that stuff can break too. You want to be there if the res breaks and it takes off and skyrockets. What we have here is no trigger at the moment on the daily chart. This gold daily, oops, I just moved something funny. Okay, well, I don't even need that there right now. This gold daily triggered a long time ago, or a while ago anyway. Here, 50.34 long was down here. We already had support building up. We would have had support at that point because we had taken out prior swing highs, so we would have had symmetry support down here, indicating that we had a uptrend forming. 50.34 long, so we would have been long here and looking to exit we're approaching now. The 50 CCI being way above the plus 100 line is saying it's extended and likely to pull back. That's why you want to take the entry when there's a trigger, not just because it's breaking out or because it's, some people use the trigger, like I said, some people use moving average crossover, some people use price action if it takes out a prior swing high. I mean, here we came down to this fib support. Here was the high of the swing into the low. Some folks would go long just because it took out that swing high. But that's a defined trigger, so it's fine. My only point here really is define where your support and resistance is, and don't just jump in. Have something written down that tells you, in this case here, what's written down tells me that my trigger was the 50.34 here earlier. Right now my plan would be to stand aside. At least not enter a trade right now. It's too extended.
Where I'm getting kind of mixed up in markets is I guess there's a timing tool. I usually use the Control E and Control R. That's all as far as I get.
Okay.
That's what I used to use anyway.
For the expansions and retracements.
Yeah, and then you're throwing all these other. I got 1, 2, 3, 4. I don't know where I'm being.
I only added 2 other tools.
Blown or what? I don't know.
I only added 2 other tools to that.
Okay.
The timelines and the time expansion.
I guess I get to zero that in.
Okay, well, right now is the time to, I guess, gather the information, and as I said this morning, slowly add these things to your arsenal. Okay, start working with, if you're comfortable with your retracement work and your expansion work, if you're fine with how that does and you want to experiment with the timing, add one of the timing tools, the 2-point tool, the one that says timelines, if you want to work with timing.
See, I thought the time expansion was the extreme because it has the ones. Number 6 is 1. I thought that was the 100 or something of that sort. I guess that's what I'm having a problem with. That's all.
Okay, well, yeah, maybe at some point we'll sit down together and I'll take a look at what's on your charts and we can work on it that way. And worry.
One of the problems is to decide how many bars constitute a swing, or is there any characteristics? If you read Dr. Krause's book on Gartley treasures, he describes what makes a swing. And sometimes I've seen people draw swings. And do you have any criteria that will make you accept a movement as a swing?
Simply that it's a pivot that is outstanding, where there was a directional shift. I'd like to see it on the time frame we're dealing with. A swing, I'd like to see 3 bars. I'd like to see 3 bars on that time frame. It's not essential though, but let me turn that question around a little bit. Why is it necessary to define the swing for timing work?
No.
Okay. Because I might have a different answer, depending on what.
Okay. For even the price, the price action. What really constitutes a swing? I mean, do you have to have 3 bars?
No, in the price work you don't, because if you had, let's say for instance here, let's pretend for a second that, let's not pretend. Yeah. No, you know what? I know. I see poor Chris back there going, I'm going to give you my laser pointer because I have a good one, and I keep saying I don't like them. I don't want it. No, I don't. I want to get over the instinct to use it. Let's say we have this swing here. You can see where I'm pointing, right? I'll make this guy. Okay. Now, if I'm looking for symmetry resistance, for example, this did indeed come down, make a low, and have a corrective bounce. What if this were only 2 bars? It's still a corrective bounce, right? It's still a place where it hit a low, made a high, and failed. So I would want to use that low to high to project from the new low for the symmetry resistance. So it really doesn't matter to me the number of bars. If it were only 1 bar, I'd still kind of have to use it if it was making a low and a high in the same bar on a daily chart, but I'd prefer to include that information on an intraday chart.